Hello learners, this is Dr. Naveen Tiwari, Associate Professor, School of Computing, Graphicera, Hill University, Bhimtal campus. In the last lecture, we were discussing about secure investing in digital age. In this lecture, we will see more about challenges and threats in secure investing. Our learning objective of this lecture are understanding crypto investing, understanding cyber safety in finance, crypto investment risk, understanding the challenges and threats. Cryptocurrencies are known for their extreme price fluctuations, which can lead to significant gains or losses in a short period. Risk: investors may experience rapid, unpredictable changes in the value of their investment, making it difficult to maintain long term strategies. Example: Bitcoin's price has fluctuated from less than $1,000 in 2017 to over $60,000 in 2021, then back down again. Now, crypto investment also has lack of regulations. The absence of comprehensive regulations make cryptocurrency market more susceptible to manipulation and frauds. Cryptocurrencies are not subject to the same oversight as traditional financial market, which increases the likelihood of scams, fraudulent project and market manipulation. Example: pump and dump. This is scheme where the price of a cryptocurrency is artificially inflated by misleading or fraudulent means only for it to crash shortly after. Cybersecurity risk in crypto investment: hacking, phishing, and other cyber threats can result in the loss of crypto assets. Digital wallets and exchanges are common target for cyber criminals. A lack of proper security measures can result in funds being stolen or lost. Example: major exchange hacks such as the Mt. Gox hacks, where 850,000 bitcoins were stolen, causing massive losses for investors. Scams and fraudulent schemes in crypto investment. The risk of new cryptocurrency and DeFi platforms can make it difficult to differentiate legitimate investments from scams. Ponzi schemes, fake ICOs, and fraudulent cryptocurrency project can deceive investors into losing money. Example: fake ICOs, where fraudsters promote a new cryptocurrency to raise funds only to disappear with the investors' money. Regulatory uncertainty in crypto investment. Different countries have different views on cryptocurrencies, ranging from embracing them to banning them outright. Sudden changes in regulatory framework can impact the legally and liquidity of cryptocurrencies, affecting the value of investments. Example: China's crackdown on cryptocurrency mining and trading has caused large price drops in global cryptocurrency markets. Market liquidity in crypto investment. Some cryptocurrencies and tokens have low market liquidity, meaning it may be difficult to sell them at the desired price. Low liquidity can lead to price manipulation and problems with existing a position when needed. Example: lesser known altcoins or new tokens may have fewer buyers, leading to larger price swings and difficulty selling. Technology and smart contract risk in crypto investment. Smart contract, the backbone of many decentralized application and DeFi platforms, can contain bugs or vulnerability that lead to financial losses. Bugs in a smart contract or the code that governs them can result in incorrect transactions, loss of funds, or unintended outcomes. Example: the DAO hack in 2016, where an attacker exploited a vulnerability in the DAO's smart contract, leading to the loss of 60 million worth of Ether. Environmental impact in crypto investment. Mining cryptocurrencies, particularly Bitcoin, requires vast amount of electricity and computational power, contributing to environmental concern. Environmental concern may lead to stricter regulation and potential halts on crypto mining operations in certain regions, affecting the value of mining dependent cryptocurrencies. For example, the growing debate about the carbon footprints of Bitcoin mining has resulted in increased scrutiny from environmental groups and governments. How to mitigate crypto investment risk? Research thoroughly. Always conduct thorough research before investing in any cryptocurrency or platform. Check the project's white paper, team, and track record. Use secure wallets. Store cryptocurrency in secure offline wallets instead of keeping them on exchanges. Diversify investment. Avoid putting all your funds into one asset. Diversify across different cryptocurrencies and other assets classes to mitigate risk. Follow regulatory developments. Stay informed about legal and regulatory changes related to cryptocurrencies in your region. Avoid get rich quick scheme. Be caution for investment that promise guaranteed high returns. If it sounds too good to be true, it likely is. Phishing and account takeovers, risk and prevention in the digital age. What is phishing? Phishing is a type of cyber attacks where attackers impersonate legitimate organization or individual to trick victims into revealing sensitive information such as password, credit card numbers, or personal identification detail. Common types of phishing are email phishing, where fraudulent email that look like they come from a legitimate source like banks and commerce sites asking for personal information or credentials. Spear phishing, highly targeted phishing attacks aimed at a specific individual or organization, often using information gathered from social media or other sources. Smishing, that is SMS phishing. Phishing attempts via text messages where attackers send link or fake offers to lure victims into providing personal information. Wishing, yeah, that means voice phishing. Scammers impersonate legitimate institution over the phone and request sensitive detail like account numbers or password. What is account takeover? Account takeover occurs when cybercriminals gain unauthorized access to a person's or organization account, often using a stolen credential. Once in control, they can make unauthorized transaction, change setting, or steal personal information. How account takeover happen? Credential stuffing. Cybercriminals use stolen username and password combination to try and gain access to accounts on other websites. Weak password. Poor or reused password make account easier to hack. Phishing and social engineering. Attackers use phishing tactics to trick users into providing login credential or other sensitive information that can be used for account takeover. Impact of phishing and account takeover. Financial losses, identity thefts, reputation damage, privacy violation. These are the important impact of phishing and account takeovers. Phishing and account takeovers. How to protect against phishing? For individual, be caution of unknown links and attachments. Use multi-factor authentication. Verify request. Look for red flags. For businesses, educate your employees. Implement strong authentication. Use anti-phishing software. What to do if you are a victim for phishing? Change your password immediately for any affected accounts. Report the phishing attempts to the relevant authorities or the organization that was impersonated. Monitor your financial accounts for unusual activity. For account takeovers, immediately contact your bank or service provider to lock down the affected account. Change passwords and enable two-factor authentication on all other accounts. Reports the incident to the relevant authority and credit bureau if necessary to prevent identity theft. The risk to new, that is first time investors navigating the investment landscape. Lack of knowledge and experience. First time investors often lack the experience to understand market trends, investment vehicles, and the other underlying risk. This can lead to poor investment choices, especially in volatile markets. Its impact is overtrading and wrong asset allocation. Lack of knowledge may lead to impulsive decisions such as buying or selling frequently based on market noise. New investors may overexpose themselves to high risk assets without understanding diversification principles. Mitigation, education, and start small. New investors should invest time in learning and basics of investing, such as asset allocation, risk management, and how different investment types work, like stocks, bonds, real estates, etc. Begin with a modest investment portfolio to minimize risk while learning the ropes. Emotional decision making. Emotional reactions like fear or greed can lead to irrational investment decisions. First time investors may panic during market downturns or chase get rich quick schemes during booms. Its impact is panic selling, selling investment during market declines out of fear only to realize later that price rebounded. And next is FOMO, fear of missing out. Jumping into high risk, high reward investment without proper research due to fear of missing an opportunity. We can mitigate in this emotional decision making by developing a long term strategy, having a clear investment plan with specific goals, and avoid short term market fluctuations. Stay calm, stick to your plan even during volatile period. Consider using automated investment strategies to reduce emotional bias. Overestimating returns. New investors may have unrealistic expectations regarding returns, especially after hearing about other success stories in speculative market like cryptocurrencies or individual stocks. Its impact is disappointment and financial losses. Expecting high returns can lead to choosing overly speculative investment, which may result in significant losses. Underperformance. Focusing on high risk investment may leave the portfolio too concentrated and unbalanced. To remove this, set realistic expectation. Understand that consistent, moderate returns are more typically over the long term. Diversify investment, spread investment across multiple assets classes to reduce the impact of volatility on the overall portfolio. Scams and frauds. New investors are often targeted by scammers offering too good to be true returns or investment opportunities in high risk assets like unregulated cryptocurrencies or Ponzi schemes. Its impact is financial losses, identity theft. Investors may lose their entire investment due to fraudulent schemes, or sharing personal or financial information with scammers can lead to identity theft and further financial losses. You can mitigate this by research and verify. Always verify the legitimacy of investment platforms and check whether they are regulated by appropriate authorities or not. Avoid get rich quick schemes. Be wary of offers with promises of high returns with little risk. If something sounds too good to be true, it probably is. Overconfidence and risk taking. New investors may become overconfident after seeing initial gains or hearing success stories, leading them to take on more risk than they can afford. Impact of this risk is concentration risk. Investing too much in one assets or sectors hoping for higher returns can lead to devastating losses if the investment underperforms. Leveraging using borrowed money to make investment can amplify losses, leading to more significant financial setbacks. You can mitigate this by diversification, spread investment across different asset classes to minimize the risk of major loss in one area. Risk assessment. Understand your risk tolerance and avoid investment that are more volatile than you are comfortable with. Fees and hidden cost. First time investors often overlook the impact of fees and hidden costs associated with create certain investment products like mutual funds, ETFs or advisory services. Impact of this risk are diminished returns, unforeseen cost. Over time, high fees can eat into investment returns and reduce the overall value of the portfolio. Hidden fees such as exit fees or management fees can lower the net returns of an investment. Transparency and low cost option is the mitigation of fees and hidden costs. Always ask about the fees before making an investment and ensure you understand all associated costs. Consider low cost investment option like index funds and ETFs which have lower management fees compared to actively managed funds. Regulatory and tax risk. New investors may not fully understand the tax implementation of their investment or the legal regulations around certain investment vehicles, leading to unexpected financial liability. Impact of this risk is unexpected tax liability and legal risk. Investing in unregulated or illegal market can result in fines or even criminal charges. You can mitigate this by tax planning and compliances. Learning more about tax implication of your investment choice and consult a financial advisor if needed. Always ensure that the investment products you choose are compliant with local regulations and are from reputable regulated institutions. What is cyber safety in finance? Cyber safety in finance refers to the set of practices, tools, and measures aimed at ensuring the security and potential of financial information, transactions, and assets from cyber threats. It focuses on safeguarding sensitive financial data from unauthorized access, theft, or fraud, and ensuring that digital financial services such as banking, investing, and transaction are secure. In the context of the modern digital landscape, cyber safety is crucial as more financial activities are conducted online, including mobile banking, e commerce, online investing, and digital payments. Protecting personal and financial data. Cyber criminals often target financial institutions and individuals to steal personal information, banking credential, and payment details. Cyber safety measures are encryption. Use of encryption technologies ensure that data, especially sensitive financial data, is unreadable to unauthorized user. Data masking. Sensitive data is hidden or altered to protect privacy. Secure network. Financial institutions and customers should ensure their networks are secure and avoid using public networks for financial transactions. Fraud prevention and detection. Fraudulent activities, including identity theft, phishing scams, account takeovers, and transaction frauds, can lead to financial loss for both individuals and organizations. Cyber safety measures for this is two-factor authentication, fraud monitoring system, and multi-signature approaches. Financial institutions often employ AI and machine learning technologies to detect unusual transaction patterns and prevent fraud in real time. For high value transaction, multi-signature technology can ensure that multiple approvals are required, adding extra layers of protection. Secure online transaction. Unsecured online payment system, transaction platforms, and mobile apps can be vulnerable to hacking and data breaches, exposing users to financial losses. For this, cyber safety measures are SSL, Secure Socket Layer Encryption, tokenization, payment security protocol. Ensure that data exchange between the user and the financial institution is secure. Payment data that has no meaningful value, thus preventing fraud even if intercepted. Protocols like 3D Secure provide an additional verification step during online payment, reducing frauds. Protection against phishing and social engineering. Cyber criminals often use phishing emails, phone calls, or social media scams to trick individuals into providing sensitive financial information such as password, account numbers, and social security numbers. Cyber safety measures are awareness training, regular training for customers and employees on how to spot phishing attempts and other social engineering tactics. Physical filters, phishing filters. Financial institution can use email and web filters that identify and block phishing attempts automatically. Verification processes. If contacted by a bank or service provider, always independently verify the authenticity of the request through official channel. Why is cyber safety critical in finance? Cyber safety is critical in finance because protection of assets, regulatory requirements, maintaining trust, preventing of financial crimes. Cyber attacks targeting financial institutions, digital wallets, or individual can lead to the theft of funds, which can have a devastating financial impact. Protecting financial assets is the primary concern for both consumers and businesses. Governments and regulatory bodies across the world have introduced stringent data protection regulation, examples GDPR and CCPA, requiring financial institutions to implement strict cybersecurity measures. In an industry where trust is paramount, any data breach or security lapse can severely damage the reputation of a financial institution or service provider. Cybercrime activities such as money laundering and fraud are rampant in the digital world. Cyber safety measures help to prevent these activities and protect individual and organization from financial loss. Now, the key takeaway in this lecture are cyber safety in finance is about ensuring that individual and organization can confidently participate in the digital finance ecosystem with secure access to services and protection of sensitive data through safety measures, equitable access and user empowerment. Financial institution and consumer can mitigate risk and unlock the full potential of digital finance by prioritizing security, embracing innovation and educating users. We can create a more inclusive and secure financial landscape. Would you like further detail on any of these key takeaways or how to implement them effectively? Our learning outcomes are: we understand crypto investing, we understand about cyber safety in finance. Thank you.